Okay, so when I was looking at these topics, I was thinking, you know, what is it that a business sort of needs? I've got this company set up. I may be a startup. I may be already operating for a while. And as you already know, you have to be a company to do R&D. In some cases, when they're a startup, there's a nil, but in some cases not, there's income. And if we go through, we'll go through some of the rules later, but you can see that it's a company level and the early stage innovation companies, which I refer to as ESIC, ESIC, so early stage innovation company. That is the other provision I'm going to be talking about, or the concession. That's really benefiting the shareholder, so the investor. So it's how to get money into your company. Whereas the R&D is how to get money into your company as well, just from different angles. One's from the government, one's from your investor. I just tried to do here is show, now there is a third column there, ignore that, that's employee shares. I just threw that in because I think that's also another thing that's also useful for innovative companies, but not for today's presentation. So it's interesting to see where the R&D tax incentive started, because it used to be called the tax concession prior to 2011. So it started 1 July 2011, and the ESIC started in 1 July 2016. And you can see who does it benefit. I think the R&D benefits the company level, whereas the ESIC benefits the shareholder level. And ESIC you only get ESIC when you actually issue shares, and R&D you only get when you do R&D. Needs to be company or share in a business. So you need to have a company for R&D. You need to have a share issue for ESIC. You need to own the IP. That's the similarities there. And you need to be carrying on R&D. In ESIC, you don't necessarily need to be carrying R&D, but it can be one of the qualifications which I'll go through. I'm going to start off with the R&D tax incentive. Most of you on the call may already be aware of it. I'm just going to run through quickly some of the first few points on there, 1.1 to 4, quickly, just as a refresher to get you in the mood. Then I just want to go through some of the pitfalls and tips, because I do find what are things to be aware of, and then some of the proposed changes. What does it mean to you, and when is it likely to apply? I thought this was an interesting slide. If you go to AusIndustry, they have this, they call it Innovation and Science Australia, an annual report. So they bring out this every year, and they sort of tell you what registrations there are. So the registrations, no, so I've got the Department of Innovation, I've forgotten the rest, but the ISA actually look after the registration process as on AusIndustry administer it. Can't even talk now. So in 2011, you can see the registrations were around 9,281. And in 2018, the registrations were 14,109. So it's a substantial increase. And you would say that probably about 70% of that would be SMEs. So under that 50 million turnover. Sorry, under 20 million turnover, not 50. So the R&D spend back then would have been 18.69, meaning that's the expenditure people would have been claiming. Whereas in 2018, it's 11.9 billion. So that's, you know, on the claims on their tax return, what they're saying they're spending, which I don't doubt. It's been an interesting time for R&D tax incentive. I just thought just a reminder of what we've been through. The Turnbull government initiated this review of the R&D tax incentive, and we call it the 3Fs report because there were 3 board members had surnames with an F in it. So hence why the 3Fs. So tax people are very inventive. That wasn't me doing that, by the way. Then in 2018, from that report and other things that have happened, you know, you've seen some guidelines and rulings and everything. The R&D tax incentive bill was released. Then there was a change of government, or I should say, didn't change, but there was a whole process of the government going through the voting, and they came back in, but the bill lapsed. In the time that the bill was in Parliament, they actually decided to take it to the Senate Economic Legislation Committee back in 2018. and they made some recommendations, but the government just ignored it. But the bill had lapsed, so it didn't matter. Anyway, the bill was reintroduced with minor changes to everybody's surprise. These are the changes which I'm going to go through later. And they've referred it to the Senate Economic Legislative Committee again. Now, the report's not due to 30th of April 2020, so we won't expect any of the legislation, the proposed legislation to come out until then. And then the Australian Small Business Family and Entrepreneurial Ombudsman, which is actually a woman because it's Kate Cannell, report came out, and that was a really good report. That really drilled down what were the main issues happening with R&D. So I didn't want to dwell on all this, but I just thought it was just an interesting thing to go through. The other thing I just wanted to note here, you can see here I'm looking, I like these little pen things, that the incentive is 16 cents in dollar because our tax rate has gone down to 27.5. For most companies under 20 million that are carrying on a business, your tax rate's 27.5. Whereas previously the tax rate was 30 cents in the dollar. So previously the incentive part was 13.5 because you were getting 43.5% rebate. So what does that mean? That means that you can see some of the changes what the government's trying to do. They don't like the fact that it's 16%. It's too much. So they want to bring it down to 13.5. And they want to bring it down so that whatever the tax rate is, it is always 13.5. Okay, so when your turnover is over 20 million, so some of you in the room may not be getting the refund, but you may be getting the rebate as a carry forward amount and offset on your tax. So what happens here is, I won't use that annotation again. So what happens here is you're getting 38.5. Some of you will experience that you're getting 27.5% tax because your turnover is between 20 and 50 million. So the 13.5 is still the benefit that you're getting instead of 16 from the tax incentive. Whereas your turnover is over 50 million, then your incentive is 8.5. So I hope that's clear enough. I think you might have to dwell on that a little bit. So remember, to get this incentive, you need to be a company. You could be a branch of a foreign entity that has a double tax agreement, won't go there. You need to own the IP. You need to be able to control what you're doing. You need to bear the financial risk. Your spend normally needs to be greater than 20,000. You can have less if you're with one of those institutional providers that's doing it. But I always ask myself, if you're going with an advisor and your spend is 20 grand, why are you doing it? You're unless it's the first year and you're going to have more spend in the following year. Okay, that's reasonable. Because by the time you go through the cost to the advisor, your costs for doing it, it just may outweigh the benefits. So only if it's worthwhile, that's the first year and you've got a big spend in the following years, or in this year, you're looking at that 50 to 100,000 worthwhile looking at a claim. And that's something I can help assess anyway. Okay, you have to have core and supporting activity. That is always the vein of the whole thing, but that's something that you need to have and identify. And you need to track and document. How many times do we need to say that? Track, document. And as you do it, really, ideally, most don't, but it would be ideal, and that is what Oz Industry would like. Okay, so what is core activity? And we've gone through this probably many a time. Some of you have seen it before. You have to have experimental activity whose outcome cannot be known in advance. Okay, yes, I need to do an experiment. What's an experiment? Experiment is need to apply a systematic progression of work based on established science principles. So computer science, bioscience, etc. Systematic progression of work looks at, you proceed from a hypothesis, experiment, observation. And the question becomes, with software developers, you don't really go through that process, but you do go through that whole idea of what's this new knowledge that I want to implement? Does it exist in the world or here? No. Or if it exists, can I get my hands on it? Do I know how to do it? Am I just simply copying somebody else's work? That's not R&D. The hypothesis is what's the question you want to answer? And it may be that you have to answer a few things together for the application. But when you go through the process of R&D, you're probably answering a few questions and maybe hundreds of questions and doing little experiments. So when you do the application, it's about joining them together. What does it make sense? Now, the other thing is conducted for the purpose of generating new knowledge by creating a new or improved product. So new knowledge, that's what it has to be. And it can be new or improved product, material, process, device, or services. Some things are easier to justify than others. Processes, for example, might be harder to justify. I wanted to just follow on from pitfalls and traps and something or tips to be aware of. The way I've sort of set it out is when you go through it logically, you look at the basic criteria, you look at the core activity, you look at some software developers, because a majority are software developers, not all, but a majority. When you look at the reports that the ISA bring out, you can see that it's probably more than 1/3 of the claims are software. And the retrospective nature of the program, which is a negative, I guess. And all these points that I'm bringing out are things that the Oz industry and the tax office are aware of. This is part of those reports that have come out, what the concerns are. And Rome is not built in a day, so nor is the R&D tax incentive. So I don't think we're going to have answers tomorrow, but we have to work with what we have. So as we know, it can't be a trust or company. A spend of less than 20,000, unless it's an RSP or CRC provider, and they're registered with the Oz industry. And they're basically set up to do R&D. That's what they're there for. Is it worth doing? As I mentioned before, what's your spend? And then do you have R&D? Because if you go through the whole process of finding out if you've got R&D and you only have 10,000 spend, that's not a good way to look. I know it's, which comes first, but you can do an estimate. Consider what is the aggregated turnover. A lot of people think it's a turnover of the company, but it's actually worldwide turnover. So any connected entities, any entities that are 40% connected to your entity. If you are foreign owned, it takes the foreign entities. If you have a majority shareholder from Australia, say for example 40-50, it takes their turnover. So hence you can go over the 50 quite easily if you're that big. Now, one thing to note is in all of these reports is the R&D tax law has not changed. Okay, so it has not changed. From 2011, legislation has stayed the same. But what has happened is Oz Industry or the ISA has applied a narrow definition of what is R&D. And hence why the professional, is up in arms at times. And you've probably heard it from your, professional associations. So the Morton resource case is a mining case, but that can be applied across the board. And basically what it's saying is the application of existing technology to a new site does not preclude it from being core. So it can still be core. So if you look at the software developers, they're sometimes using known knowledge to apply in a new way. So hence, you have to have all the other criteria. You have to have, an experiment. You have to have a hypothesis. There has to be some new knowledge being gained from it, not something that already exists out there. I'm just going to do it my way though. So that's why that Morton resource case is so important. Software development itself, Oz Industries brought out a lot of guidelines, and they brought some guidelines out, I think it was in 2019, and that confused a lot of people. And you've probably seen some stuff in the papers or rulings, or not rulings, but just, people commenting on it. What the confusion is that nowhere in the legislation, nowhere in the commentary that comes with the legislation does it refer to this Frascati manual. Now, this Frascati manual is something that the statisticians use to work out what is R&D. It's something that the government uses. And the confusion lies in this manual is because in their ruling, they refer to this manual. And the thing about the manual is that it was updated in 2015 and they refer to the 2015 manual. So they use that as a guideline to say, these things are included in R&D and these things are excluded in R&D. And hence that guideline that you would have is available anywhere, on this Oz Industry site, actually says what's included and what's excluded. But what happens is it followed the 2015 guidelines, whereas the legislation was written back in 2011, and it would have followed the 2002 guidelines of the Frascati manual. And the 2002 guidelines had additional words. And additional words means, you know, the scope would have been bigger. And I think that ATO or the Oz Industry have taken advantage and narrowed the scope a little bit. But the legislation hasn't changed, and the legislation doesn't mention Frascati manual. So all these things have been pointed out to Oz Industry and the ATO, and due to this case as well that's come out, that should, and they're looking at how do they rectify that. We go on as usual because we're following the legislation. And the Frascati manual, they've actually said afterwards, is only should be used as a guide, something to, you know, look at what is included and what's excluded, but not taken as law. So that's the prescriptive in its format. That's why I'm saying that. And it largely focuses on what is not R&D. It's not very helpful to all of us to say what is and what isn't R&D. We'd like to see some positive. Documentation, and it does acknowledge in that guideline for R&D providers, and I think there was a question about that, is that, you know, you don't have to necessarily have formal records all the time. So for example, you can have a JIRA printout of what you're doing in an orderly fashion. You can have screenshots of your experiments. You can have copies of IM messages to show what you're doing or the format you're following. The other thing we were looking at was what was pointed out in the Ombudsman report is the retrospective nature of the program. This is what probably scares a lot of people, is that Oz Industry can come in any time. Now the ATO can as well, but usually, you know, you put your tax return in, they stop it, they look at it, they go, sometimes they go, yeah, fine, go on. Other times they go, okay, let's look at the nexus. So give me some printouts of some invoices. Oh, I've got this question. You know, if you answer them right, no audit, no review, you get your refund, on you go. And some of you would have experienced that. If Oz Industry comes along, looks at your claim and says, oh, no, you don't have R&D. This is not R&D. Or you haven't proved it enough because you haven't got enough documentation to support it, then they'll go back to when that particular project started. That could have been 2 or 3 years ago. And what does all that mean? And that has had negative effects on some businesses where it's, you know, they report back to the ATO, how do they repay it? So again, Oz Industry is looking at ways, how do we reduce that risk? And one of the recommendations made was that when an applicant it's the first year application, maybe Oz Industry should be looking at it then. Makes sense, right? And making sure their claim makes sense and is R&D. I like that idea. Now, the other thing that we get asked is salary and wages. You know, Ozone Manufacturing is a case that sort of talks about timesheets and so on. And the reason why they didn't win the case with the ATO, which is the one that looks after the expenses, I should say, is it didn't have enough documentation and it didn't have timesheets. So they're very ad hoc. It just didn't make sense. They were more, you know, recording that they came in the office and out of the office, punching cards sort of thing. So timesheet is a timesheet. Like, yeah, accountants are used to timesheets. We keep timesheets. But I know that a lot of these JIRA system project management systems do keep a check on people doing activities. So, you know, that is in effect your way that you may keep your timesheets. A lot of the bigger organizations do keep timesheets for the R&D projects, and they break it up into which projects. If they have 3 projects, then they do it there as well. Do you need timesheets? Well, you know, look, they say that you don't need timesheets, but if you don't have timesheets, how do you prove it? You could go on to monthly meetings or weekly meetings and jot down what the person's been doing, and that could be a record. But in an audit situation, it's going to be hard. So it's best to keep some timesheet record. That would be my recommendation. Contracts, when you're subcontracting work, just make sure you subcontract to Australian subcontract. It needs to be done in Australia, even by the subcontractor. Should the ATO look further and they find the subcontractor is doing the work overseas, then it may be denied that cost. So just be aware of that. So, you know, ask the question when using a contractor. You know, stipulate it maybe in your agreement that it's done in Australia by the Australian contractors. Depreciation. So another question I've had in the, you know, some of the bigger questions sort of thing is that instant write-off. Now you know that you've got the small business write-off and you've got the other, if you're not a small business, you have a medium business, you have another write-off. So at the moment, the government has got this whole incentive, you know, as part of the stimulus plan, is that you can write off, you know, buy something for up to 150,000 up to 30th of June, and you get a write-off. Woo! You got to have the money for that, and the problem at the moment is people are going to hoard their cash. So the instant write-off. So if your experiments are to do something, say for example, you need 50 cameras, and cameras all cost you more than a certain amount of money, at least 1,000, 2,000, depending what camera, and you install these cameras because you need to monitor something or sensors, you can't just instantly write it off. Or you can write it off, but then you can't be part of the R&D claim. So if you wanted to be part of the R&D claim, then you need to claim it and depreciate it. And then you get the incentive on the depreciation, just to be clear there. Overheads. Another thing, you know, the ATO is threatening to bring out guidelines in this, but that's been threatening for about 3 years and nothing's happened. When we had the R&D tax concession, it was very clear there was a guideline saying, you know, you can use apportionment basis on, you know, you look at your R&D staff salaries over your total salaries, and that percentage, you could take a percentage of your overheads. When I was in a roundtable discussion with the ATO and Oz Industry, they said, oh yeah, you know, that guideline's been withdrawn. So they say, oh, you have to look at each expense and see, does it make sense? So if your staff are all in the office and you're looking at, you know, electricity, you're looking at rent, all these kind of things, insurances, it makes sense to use that apportionment, but it might be something else that needs a different type of apportionment method. And so we look at that when we go down the P&L and assist you with that. Ineligible expenses. It's always good to work backwards. I like working backwards, clearly. Is make sure your expenses are not ineligible. So there are certain expenses that are ineligible. So marketing expenses, research for customer satisfaction or customer need, that kind of thing, and or social human experiments. All those are out as core, but it could be part of supporting. So that's what the first thing to look at. In-house developed software. If you're developing software in-house for yourself, then you can't claim R&D on it. It's ineligible, excluded as R&D. So the question I think to ask is, what you're doing, is it related to delivery of a service to customers? And then it's more likely not to be ineligible. Now, with the refundable tax offsets, this is the proposed changes. Now, they're proposed to change this to 1 July 2019. It used to be 1 July 2018, but obviously that legislation lapsed. And then they made minor changes to the legislation, as I said, and they're bringing it in from 1 July 2019. Now, as I mentioned, they're looking at it, and we won't have a report until after 30th of April. So I don't think we're going to hear anything until May, June, probably June. Now, if the sense I get from all of the talk around the place and practitioners and everything, I don't think this is going to go through. I'd be very surprised, but I have to tell you about it because I like to tell you. Okay, so with what's going to happen is if you're under 20 million turnover, so currently you're getting 43 cents and 43.5 as a refund. Now what's going to happen is that it's going to be 41%, but it's going to follow your tax rate. So your tax rate is now 27.5. What they're going to do is corporate tax rate plus 13.5. So when tax rates drop down to 25%, it'll be 25% plus 13.5. So as of from 1 July, if this legislation gets passed, and I'll be providing more information about this, so don't worry, you won't miss out, it'll be 41. They're proposing to cap the refund to 4 million unless you're a clinical trial. Okay, so if you do clinical trials, pharmaceuticals, then, and there's a definition of that, then you're fine, you get more than 4 million. If you turn over, so you must be pre-profits, pre-sales. If you're a business that has 30 cents in the dollar, I would say, are you really carrying on a business? But anyway, that would be 43.5. So I just put that there as an interest. But the excess over 4 million isn't lost. It's carried forward like a non-refundable tax offset. So you can carry it forward like you carry forward a loss and use it against your tax in the following year, which would affect your franking credit, like you all know. This is the big change, and this is where it's very convoluted, but I'll go through it in a very simple manner. And what they're really trying to get at here is if your turnover is over the $20 million, then what they're trying to do is only give you, it's a bit like a progressive rate of tax, and they're trying to say the more you spend on your R&D versus all your total expenditure, then the bigger your rate will be. So take, for example, if your expenditure, if you get your the intensity rate is your R&D spend over your total expenditure gives you less than 4%, then on that R&D expenditure, you only get 4.5%. That's it. So your tax rate plus 4.5%. If your expenditure is over 9%, then they work out, they'll go through 4.5% of your R&D spend. So they'll look at the R&D intensity. So they'll look again of your whole R&D. What's 4.5% of that? Sorry, what's 4% of your total expenditure? And take 4.5%. And then they go to the next level. What's between 4 and 9%? And then take that portion of your total expenditure and then give you an 8.5% on that portion. So progressive. So anything over 9%, you get 12.5. If you think you're confused, well, I'm confused. So hence why I don't think this is going to go through. It's just a nightmare. This is only for people with over 20 million turnover, so who are getting the rebate. So you can see from there is that in the second column, the first 4%, you're getting 4.5% on your R&D spend. So you're really getting 34.5%. It's or if your tax rate is 27.5, you're getting 32. So is it worth it? Whereas if you're in excess of that 9%, then you're getting 12.5. So as you saw earlier, you're currently, you'd be probably entitled to, if you're over 50 million, you're entitled to 8.5. So it is a much better concession, but you'd have to be, your R&D spend would have to be 9% of your total expenditure, and that's quite large. Also, what they're proposing is to cap, probably not a problem with any of us, but the R&D expenditure to limit it to 150 million instead of 100 million. I don't think I have that problem at the moment. I don't have any clients with that kind of spend, so we're all good. There are other measures coming in. They're proposing, they're changing some of the clawbacks, which I'm not going to go through, because again, if they do go through with this, I will go through with you a bit more in detail, and we'll have another session, or I'll do an alert or something. The other thing they're proposing, more transparency, reporting, some of the R&D spend some companies have, etc. But let's see what happens. I'm going to move on now to the early stage innovation company, ESIC. So I'm going to say ESIC all the time. So if you forget what it is, come back to this slide, please. So we just want to go through the facts, timeline, benefits, the pitfalls, bit diagram, and some changes in the legislation, not massive for this concession. So this concession is fantastic. So if your business is not a startup, but you're looking at starting up a business, it's something worth looking at. Look, I've got a little halo here. This background thing is fantastic. Now, life as a startup, because this is really for startups. Life as a startup, you've got your founder there, you've got new company, they're shaking hands, yep, they're all happy. Set it up, you've got an idea, you conduct your R&D, maybe in the first year, maybe not, maybe it's the second year. Then you get your investors in. Now, it could be any order, I just put it in this order. So your investor comes in. What's going to attract your investor into your company? It's probably viable, but it must be fantastic, but what's going to attract them? So this ESIC is for that purpose. So what is it? It's at the shareholder level, so that you get a 20% tax offset. So you're capped at 200,000. So if you spend $1 million, you get 200,000 per year. You can put in 20 million into different companies, but it's capped at 200,000. That's the cap. Anything over non-refundable carry forward offset. So if you don't use it all, the 200,000, you get to carry it forward. Then the big thing about this, because no one really cares about the 20% tax offset, although that is nice, is that there's a capital gains exemption. So there's no capital gains when you exit this startup business, as long as you meet these criteria, of course. So that's a great benefit. So in year one, you would have a capital gain if you did sell it or anything happened, but then you've got to ask yourself, what is the value? You've probably got a capital loss. But the reality of it in year one is that you may not get the capital loss. So if these provisions apply, you don't get a capital loss. That's the danger of it as well. But from year 1 to 10, there's no capital gain. So if you exit within 3 to 5 years, exit within 1 to 10 years, no capital gains. But there's also no capital losses. So if you exit and make a loss or it just stops, you don't get a capital loss. But everybody goes in pretty optimistic. So I'd say you want a capital gain. So from year 10 onwards, what happens is they take the market value and then the excess of that, you pay capital gains. So you do have a cost base. So that's really great concession. So what is early stage? So early stage is recently established, 3 to 6 years, and there's different rules. That's why it's 3 to 6 years. The revenue is in the prior year less than 200,000, and the expenditure in the prior year is less than $1 million. So that's very important. So you've got early stage, which I talked about. They've got to be innovative. It's a 100-point test or a principle-based test. So you have to pass the early stage. You have to pass one of the 2 innovations, and you can't be a company listed on the stock exchange or not a foreign company. Also, it's important just to look at, if it's looking at the current year, it's looking at the prior year. So if in the second year you issue shares to a new investor and it's not listed, not foreign, then you look at if it's less than 200,000 the prior year revenue and less than expenditure of 1 million to meet this criteria. So on the innovation test, we said there was a 100-point test. That's the easiest one to meet. But the problem is you don't meet it in the first year. You'd never meet it in the first year if you're looking at getting investors, because you need to have one of these criteria, and usually it takes, it looks at prior year. So if you didn't exist in the prior year, it wouldn't apply. So take, for example, the first one, 50% plus of total expenditure in prior year is R&D expenditure. Then you get 75 points. You still need another, 25 points to get to the rest, to get to the 100. So sometimes it's easy to meet, because if you meet it, it's easy. You go 100 points, okay, done, move on. Do I meet the other criteria? Got it, okay, good, report, done. But in most cases, what happens is that a lot of the entities will have to go down the principles-based test. So how does it work? It works usually by, there's probably been over 200 rulings being put into the ATO. So it's a ruling to get certainty. You don't have to put a ruling in, but most do, because then they can show their investors that it's an ESIC. It meets the criteria. So it's got to be for the entity has to be developing for commercialization. It's got to be scalable. It's got to be broader than the local markets. It's got to have a competitive advantage, high growth potential. And there's a whole criteria around all those. And, look, if private rulings are available to the public, obviously they take the names out. So you can search those and you can look down and see what is developing for commercialization, what do people put in there. But most of those have been approved. There's been no issues with them at all. So it's just a little bit more work, that's all. And that's something we've assisted a lot of clients with. From a shareholder level, so this is the shareholder that's getting the benefit. Shares have got to be issued on or after 1 July 2016. So when this came in, unfortunately, some had been issued out before that date, so they don't get the concession. ESIC and shareholder must not be affiliated. So that means, where a founder sets up the entity 100%, they're not likely to meet these rules. This is made for, these rules are for investors to get funding for the startups. Shareholder must not hold more than 30% in the ESIC. So it has to hold less than 30%. And there's some tricks around that, so that's something we can assist entities with. And can't be an employee share. So the employee shares are excluded. And a trust, so you can be an individual that invests in the company, you can be a trust, you can be a partner in a partnership, but they're treated as individuals, and I'll go through that in a minute. So shareholders, the investment limit, you can invest as much as you like. So even there's a limit, there's a maximum limit of 200,000 for the purpose of the rebate, but you can get the capital gains on the whole amount, even though you've invested more than $1 million on all your other investments, so long as they're ESIC, of course. Now, you've got to be a sophisticated investor, and you know what that means. 250 turnover, 2.5 in assets, you can include your super fund assets, etc. Retail investors. If you're a retail investor, you can only invest up to 50,000. So the rebate is only 10,000. You can't invest more and get 10,000. If you invest more than 50, you're out. Harsh, I know, but true. So this is what it looks like, you know. An entity incorporates, you've got 4 founders, they come into the business. They might be investors, because I have a scenario where the client does all the, looks at the what the technology is beforehand. They all think this is a great idea. They get 4 investors in, boom. So they've got all less than 30%. They're not affiliated. Got a fantastic idea here. Put money in, get the IP in there, or get the cash to do the R&D, etc. But unfortunately, because it's in incorporation, and even though the whole time you're looking at this is the time of issuing of the share, and immediately after, do you meet this criteria? But you know, the ATO is adamant and hasn't been fought in the courts yet, which I think it could be. But on incorporation, you can't meet that. So there's ways around that, and that's something we can discuss if you're ever interested. So another problem we've encountered when people have come to us for the ESIC is that they've set up and they had this great idea, the founders set up, and then they said, oh, look, you know, a lawyer's got in there, another accountant's got in there and said, okay, let's restructure this, because, you know, normally what happens is you hold a holding company, you hold the IP in one operation in the other. If anybody attacks the operations, the IP is safe. Great. Problem with that is that you have to directly hold the IP in the holdco. So this structure doesn't work to get the benefit. And again, we've requested advice from the tax office regarding that. But a way around that is to simply put well, when you set up, you've got the IP in there, you probably haven't got an operation anyway, so you leave it all in one company. But when the operation starts, you put a sub in there and put the operations in a sub. You're still protecting the IP. Now, this is only immediately after, so if you're looking at issuing shares, you set it up this way. If you've already issued shares, you're not going to issue anymore, or you're outside these rules, then you can set it up any way you like, right? Tax consolidate, bring up another entity down the bottom, and you're done. So it's all good. So that's why it's important just to discuss it. Nothing to be cautious about, and we're going well with time. I'm happy with that, because no one's interrupting me. It's fantastic. And did you like the background? I'm actually at home, but the background looks like I'm in the office. Fantastic. Deception, that's what I call it. So we've got its ESIC here, and you can see you've got a discretionary trust, as we indicated before. And you're probably asking yourself, how do you get the tax offset if I've got a discretionary trust? And then I've got a company investing in it. So what are the benefits here? Now, I could be an individual holding the ESIC. That means I just get the rebate and the capital gains. If I hold it through a trust, it's fine. You can do that. What happens is that the discretionary trust is treated as an individual. And I'll go through the timing afterwards. But effectively, you have to issue a notice or decide by a certain time which member or beneficiary is going to get this offset. So you could have the income streaming to one individual and the offset to another. Okay, so that's the trick around that one. The company itself, it's probably not good for a company to invest in an ESIC because it can't pass through the tax offset. So the company might get the tax offset, but it's got a company tax rate. And when it wants to pass it through to the individual, there's no tax being paid, so you've got an unfranked dividend. So that's the issue with that one there. And remember, put your little messages down there, and I can always go back to a slide. So timeline of events, I think this is useful just to get a big picture of the whole of what I've been discussing here, is entity might be formed 1 July 2019, for example. Somewhere in between 30th of June 2020, you issue shares. So you've issued shares, you come under ESIC. By 31 July, if you issue in any financial year, by 31 July 2020 in this case, you need to report ESIC to the ATO, and that probably would be done under single touch payroll, the mechanisms under there. By 30th of September, the trustee has to notify members. Now remember that you always 31 June, you always have to have your distribution resolutions done by. This is different. This is the trustee has to nominate the member that's going to get the ESIC rebate. It could be members as well, by the way, but at maximum of 200. Even if there's 2 members, it's 200, 100 each, or whatever apportionment you like. But the trust is effectively treated as the individual, so it only gets the 200. And then you might have a situation where you did R&D as well at that 30th of June 2020 year. So, 30th of April, you might lodge your R&D application. And then 15 May, you may lodge your tax return. Obviously, everyone has different lodging of tax return dates. So you might do, you might want to do your R&D July, August, and lodge your tax return because you're getting a refund. That's probably better. But, it was always some delinquent clients, and you're probably one of them, that like to leave it to the last minute and make us panic. Due to all the circumstances, they have provided an extension for the 30th of April to lodge the R&D. So if you haven't done it and haven't thought about it, and you're now thinking about it, for the 30th of June 2019 period, you have until the end of September. So that's a good concession. Mind you, unprecedented circumstances. I've gone through the presentation that I was going to go through. Oh, there is some amendments to apply from 1 July 2018. But again, I don't think these would affect many of you. If you do have questions on them, I can have a chat with you later. So just going through that presentation, just want to see if you've got any questions.
Mariana, there's a question in the chat box. What is the date of the extension for FY 2019?
Okay, yeah. So the extension is to 30th of September. So usually at 30th of April, so it's 30th of September.
We've got another question. Question on R&D rebate. Can you still claim on the brought forward depreciation?
If you mean by that question, Timothy, if you've got depreciation 1 year and the following year you're depreciating, yes, you can keep claiming the R&D on that. Or you're using an asset that you haven't used maybe before in R&D, so you might have brought forward depreciation on that and using it for R&D. Yes, you can claim the depreciation every year. I hope that answers it. As part of the stimulus, not asset write-off, but as part of the stimulus package, well, it's sort of, yeah, it's part of the stimulus package, you're right, but effectively they still follow the legislation to say, are you an entity that's a small, medium business to get the write-off. So what if the company's tax return already done? Does it affect the R&D claim? Bobby, I have to just maybe understand that question, if you can help me to understand that. If you've already completed and lodged a tax return and you think you have R&D, then potentially you've got until September to do the R&D for 30th of June 2019, and you would have to go back and amend your tax return. All right, so yes, we can assist with that.
What is the best way to defer an income tax return lodgement due to date? For example, if we are waiting for the R&D registration number from Oz Industry or haven't lodged the R&D TI application yet?
Yeah, I mean, there's 2 ways to handle that. One is to lodge the tax return the way it is, and when you get I don't know how far done, you haven't lodged the R&D application yet. One is you could lodge the tax return as is. So, but if you have tax payable, you might want to hold off on that. But I would ask for a deferral. And most of the times we've been very successful with asking the ATO for deferrals, especially in these circumstances now, and say that you're trying to do the R&D claim. So then you can have time to do the R&D claim. I hope that answers the question.
I have another question. You mentioned a trustee in the ESIC regarding they holding the shares for investors as a custodian or as a trustee.
Yeah, so what happens is it's just like a normal trust. So it's not nominee or anything like that. So it's almost like, you know, you've just got your normal discretionary trust and you've got your beneficiaries to the trust like you'd normally have. And the question becomes which beneficiary is going to get the rebate? So it's really just no different to what you already have. And it's just a matter of doing that extra member resolution to indicate that you are distributing to certain beneficiaries. Certain beneficiaries only will be getting the benefit of the 20% rebate. Maybe it's 1, maybe it's 2, maybe it's 3, and the capital gains exemption for that particular asset. But you can stream your other income to other beneficiaries. Is it ESIC or early stage concession income? I don't know what you mean by that, but it's early stage innovation companies. In relation to my above question, so that amendment of company tax return is compulsory, will we not be able to do any adjustment in 2020? Okay, so above question, you're saying you've already lodged a tax return. So in the amendment to the income tax return is compulsory. Well, if you want to put your R&D claim is, yes, you have to amend your tax return. And will not be able to do adjustment in 2020. I'm not sure what you mean by adjustment in 2020. So you can only claim expenditure that relates to the 30th of June 2019 period at the moment. So, you know, when you have expenditure in the 30th of June 2020 year, you claim it in the following year and usually have 10 months to claim it. So for 30th of June, let me just clarify, for 30th of June 2019, it's got to be expenditure for that period. So you've lodged a tax return for that period, you may have already lodged it because it may have been due. If you haven't done the R&D claim for that particular year, 30th of June 2019, you can still do it. You'll have to the end of April normally, but an extension to 30th of September. When you get that, you would be amending your 2019. It doesn't affect your 2020 because you still have to do an application for that year. So it's a new year.